Hello and a warm welcome to Personal Finance. I'm Gugulethu Cele. Many people use the term investing and savings interchangeably, but these two concepts are very different. Frank Magwegwe, Segment Chief Executive of Momentum Retail, joins me now to explain the difference. Frank, always a pleasure speaking to you, but I want us to go back to the use of these two terms interchangeably. And I understand you got some of your inspiration from Alice in Wonderland.
Absolutely, yeah. Thanks, Gugu. Thank you for having me on your show. A lot of clients, as would happen typical after a budget, coming, they're looking at their taxes, they're trying to put their house in order. And I was just struck by how easily they, in one sentence, they're talking about saving, and then the next sentence, they're talking about investing. And just thinking about that really took me to one of my favorite books, Alice in Wonderland. And I ended up just thinking about the part, where they talk about you must really say what you mean.
Yes.
Because, it helps in terms of clarity. Yeah, but the idea was based on that, certainly.
Let's get then into the nitty-gritty of the definitions of the two. Saving, investing, I understand there are similarities, but let's get into saving first. The objective and the real definition of that particular word?
Yes, and before we get there, I think it's important to just take a step back and say, what are the purposes of income, or the uses rather? How do you use income? So there are really three, and I think it helps to explain the differences. So there are really three: consumption, investing, and saving. You already begin to see there's a bit of a difference there. Yeah. So coming back to your question, if we think about saving, saving is really deferring consumption. In other words, I'm putting money aside so that when I need it, it's immediately available, and I can use this for the purpose that I'm putting it aside for. So that's really simplistic thinking about saving. You're not consuming, you're putting it aside, and when you need it, it's easily available. You want to access that money.
Investing, on the other hand, does this depend maybe on the outlook? And is there still a delay in consumption with regard to that definition?
Outlook is quite important, because the moment you start talking about investing, you are saying, I want to acquire assets. Those assets could be a house, it could be shares, it could be a property, with one main objective. Out of this, I want to get profit. That's the main thing. So there's an element of I'm taking risk. And obviously because of that, a time frame becomes important. Over what time frame do you want to acquire these assets or investment, so that you can ensure that over time, you get profit. So simple examples that help are clarified, in the minds of consumers would be something like, if I want to put down a deposit to buy a car, right? So that's saving, because it's about not using this money, putting it aside so that it grows to the amount that I need, let's say 100,000, and I put down the deposit for a car or deposit for a house, for example. Whereas when you talk of, I want to make sure that when I retire comfortably, already long time frame, and there we're talking about you're investing so that that money grows, so that you'll be able to retire comfortably. Investing in shares come to mind, investing in property, for example.
I think the confusion also comes in from a perspective of the monetary value as well, Frank, because today you can save 300 Rand a month, you can invest 300 Rand a month. Yes. Is there a particular order as to which needs to come first here? You alluded to consumption, saving, then investing. Yes. Does your money structure or how you hand it out needs to be formulated in that particular order? Absolutely.
That is very important, for consumers. So one of the things that we find, myself in particular as a financial advisor, is that because of sometimes of not enough clarity around these two terms, consumers rush to invest when they should actually be saving. What do I mean by that, Kuku? Let me give you an example. Typically, as financial advisors, we say, if you're a consumer out there, what you need to do is to have a bit of buffer, so that when emergencies come in your life, whether it's replacing a flat tire, or it's contributing, somebody's passed away, it's a funeral, or any major expense that may come, you need to have money easily available to do that. So typically what you need to do is to save for what is called in the industry an emergency fund. Just money that when an emergency comes up, I can access it and I use it. So typically you find that people worry a lot about investing. What am I going to invest in? What is the portfolio? Should I be buying a share or not? But when you sit them down as financial advisors and ask, but before we start talking about investing, let's just get clarity around how much are you saving per month? That's important. Roughly, people talk about between 10 and 15% of your net income. So how much are you saving per month? That's important. Then do you have an emergency fund? In other words, you need to quickly go to a doctor, you need to buy over-the-counter in a medicine at a pharmacy. Do you have that? So that order for me almost comes when I say, if you're putting money aside and you've built an emergency fund, and typically we say that should be 3 to 6 months of your net income, just as a way of thinking about it.
Which is a lot of money.
Which is a lot of money to just build on the side to be able to absorb shocks that may come in your day-to-day. Once you have that, that's when we really start talking about, now we've put that in order, think about investing. I have a little bit of extra money, think about maybe unit trust, think about property. So the order comes in terms of almost the first question, do you have some sort of emergency fund that you've put aside to absorb shocks that may come, financial shocks in other words?
Frank, to throw a spanner into the works, everybody wants to save, everybody wants to invest. I don't think there's anyone in the world out there who doesn't want additional funding that's available. But what if you have debt? Should you be thinking about investing or even saving when you've got debt? And is there a way of maybe targeting the two at the same time?
So that's also another common mistake that you find. So when you've got debt, the important thing is to firstly understand, how much does this debt cost me? So typically, for example, you finance a car, you generally hear people talking about, I'm funding my car at prime plus 2, as an example, or at prime, right? Talking about the prime interest rate. So that's how much it costs you. So if you want to invest, you go to ask yourself, okay, I've got debt that's costing me that much. What I'm going to invest in, is it going to give me a return that is above the cost of this debt? And typically where I start with my clients, I would say if you've got debt, in particular, let's say you've got mortgage loan on your home, I would say if you've got extra money, rather put it in there. Most of the the banks would provide you that opportunity to put additional money into your loan account, your mortgage loan account. By doing that, you're saving on the interest that you have paid, and effectively you're earning that you pay your home loan over a shorter period of time, you're saving interest, and you're actually earning an investment return of prime plus 2 if that's what the loan on the house is. So taking into account how much does the debt cost me and another investment vehicle, then decide on the two. And typically you find that in most circumstances it's wiser to start paying down your debt instead of going out and exposing your capital to the capital markets where a market might come down and then you lose some of those savings.
And there's more risk there because, as you've already alluded to, you could lose some of the capital itself, never mind not making a return at all. But Frank, I want us to touch on some of the products. Are there efficient products available on the market that consumers can get their hands on in, number one, not only to ensure that their savings is taking place for 3 to 6 months, which will make anyone raise their eyebrows, as well as from an investment perspective?
Absolutely. So I would say let's start with saving. So the first thing, really understanding the budget. I always talk about the budget, really the center of a financial plan. So understand how much you're earning and how much are your expenses. Then decide on, what portion am I able to put aside and save. If you've got debt, for example, if you've got a mortgage loan, for me, how to build your emergency fund, put those savings in your mortgage loan. You reduce the period you are going to pay the loan, and you also save on interest, right? Then if you don't have a mortgage loan and you need to put aside money for saving, then there's short-term vehicles because they are worried about preservation. You don't want to lose the money. Yes. So there's accounts at banks, your 32-day type of account, your money market type of account, because the important thing there when you're saving is access to that money. I want to quickly access it when I need it. So there are quite a number of opportunities, in terms of that. Then when we come to investing, we are really talking, Gugu, about a time frame of at least 3 years and above. We're saying I'm investing because I'm buying an asset such as shares, such as a portfolio, for example, of shares, bonds, and money market instruments. And I expect over time that portfolio will generate profits or returns for me. And the mistake that happens, what really got me to think about, do consumers really understand the difference, Google, is I came across a client who is saying, I am saving for deposit because we have decided as a young family to buy a house. And we're putting this money in a unit trust. And what happened, they now have identified the property. They've put 100,000 in this for the deposit in this unit trust. Go and check the value of the unit trust. Markets have come down. You have 85,000 instead of 100,000. And then there's anger, understanding about investment. I put my money, I don't trust investing because it made me lose money. Whereas in that instance, you preserving the money, you're talking about saving, put it in an investment vehicle that doesn't lose you that much. So it's quite important to understand those differences. So real investing is about 3 year plus, because you're investing in shares, share market may come down and you may show losses in the interim. You only experience the loss obviously when you do sell out of the unit trust and you really crystallize that loss. So if you're investing for a long time, you just see that the market value has come down, but I've got a long-term view. I don't need this money now, so I'm going to wait it for growth. And generally, equities over time or a portfolio makes you get real returns over time.
Exactly. Frank, you've definitely put things into perspective, and it goes back to the fundamental understanding for someone who's watching the show this evening and wants to grasp the key concepts and the gist of this evening's conversation. Your key 3 points
I would
to
summarize
leave them
Gugu
with.
by saying the simple way that I've come up that will help consumers understand it. 3 uses of income. I consume it, I save, and I invest, right? Then what is the difference between the two? If I'm saving, my focus is preservation of the money, firstly, and accessibility. I want to be able to get it and use it where I need it. And the time frame there, typically a period of less than 3 years. When I invest, I'm looking for growth. I want the money to grow, and I would invest in something like shares. The time frame there or unit trust is a period of at least 3 years plus.
Frank, thank you so much for putting things into perspective. Hopefully a lot of South African consumers, I know myself for one, am more enlightened with regard to the difference there. Well, that's where we have to leave it for Personal Finance this evening. A big thank you once more to Frank Magwegwe, Segment Chief Executive Officer of Momentum Retail. Now remember that we want to hear from you, so get in touch with us. You can tweet any of your comments to @CNBC Africa using the hashtag Finance410 or to myself @Gukumfupi on Twitter. Until next time, have a wonderful evening.